When Governor Michigan came before us last November, he had stated that as far as the impact on small businesses of credit, that there seemed to be no issues, but it was still a bit uncertain what the impact would be. And when he went to the Senate side the other day, he made comments that, well, it looks now as though, and I'm sorry I wasn't here to listen to your testimony, but that lending standards have now tightened among the lenders for small businesses. And the rates have increased. In fact, for small businesses, small commercial banks and all, the spread is actually more now than it was previously between the cost of funds and the interest rates, probably because of the risk attendant to lending today. And so community banks are now only lending at a 12% growth this past recent month or two, rather than the 20% you'd been seeing. My question is more one of how well are we really shooting ahead of the rabbit? You know, the governor was here and said, really no issues, but it's uncertain. And now we see some harbingers, something that's more than harbingers of impact. How can you describe to me what is your monitoring out there in the field, so to speak, for the credit union, for the bank? How do you monitor this? So there's a better sense in Washington of, are we really shooting ahead of the rabbit early enough to help in some way? I say that because I was taken by the facts that, and this is what I'm curious about, is 45%, I gather, of all small businesses use collateralized real estate, which you were speaking to, to back them up. And 15% of that's personal. 47% of them use credit cards. And house finances and automobiles. How do you raise to Washington that early enough there's such an issue that's impacting if it's going to get worse? It's probably not a great question, but I'm just curious how just a few months ago somebody you hope would have a lot of foresight said there doesn't seem to be any issues right now, but it's uncertain, and all of a sudden now we're hearing, geez, this is really impacting us. I don't think it's his fault. How do you get a better view at this from you all?
Well, things have happened incredibly quickly since August of last year. Just look at the decline in the Fed funds rate. There's been a 300 basis point reduction, and depending upon how things go at the Fed today, there may be an additional reduction. So things have very definitely happened quickly. I can say for the banking community, we
they have happened quickly, but the impact is still. It seems as though even though they happened last August, here you are this past 3 months having, instead of 20% expanded, you're down at 12% all of a sudden. Are we doing enough?
Let me try to explain from our standpoint underwriting standards and how we look at credit. It's not only internal as far as the bank, but external in terms of our regulators. In a situation like this where we have an economic downturn, we quite honestly have restricted and tightened our underwriting standards. What pays back a loan is profitability and cash flow. And when the economy is not doing well, the predictability of profitability and cash flow is not there. So there are some loans, particularly loans on the margin, that may not get done in an economic downturn. If we're not doing this, our regulator is certainly going to be there making sure that we do in terms of monitoring our customers and monitoring the economy and monitoring our portfolio. So we, maybe a different way to answer your question, we look at all the different economic reports that come out, the different views on the economy, and see what's happening within our own portfolio and with our own customers. And based on all of that information, make a decision as to how to proceed.
I think from the crediting perspective, our consistency in the underwriting standards has been pretty level. When I've talked to the other credit unions around the country, and ourselves in particular, the group of 5 are credit unions that work together on the commercial lending side, we haven't changed our underwriting standards. And to be honest with you, we have no current delinquencies either. And that's more of a relative factor with credit unions who have a much smaller delinquency rate on business lending compared to our banking partners. So we haven't changed how we approach the commercial lending side from the due diligence that we do, meeting the requirements of our regulators. I think the concern that we have and that we've tried to express early in my testimony is the ability to be able to continue to offer more services to more small businesses in the community, and that goes back to the 12.25% issue. That cap level does prohibit or limit severely what credit unions are able to do in terms of serving the small business community throughout the country. And when you have the capability of being able to provide an additional $4 to $5 billion in the marketplace, that's fairly substantial and can help at a time when the tightening standards that banks have had to put into place because of the issues that they've dealt with in terms of obviously the subprime crisis issues and so on. We're here, we're ready to help fill that need at this point, but we do need some help from the congressional standpoint to be able to step up to the plate and be able to deliver those additional services in the community, and we like to do that.